Hello, this is Nick Giardina from MCOL, and I would like to welcome our listeners to today's podcast session. We are pleased to have Doug Sherlock, Senior Healthcare Analyst for Sherlock Company, joining us today. Doug is here to give us his quarterly insights into the financial markets of health plans.
Thanks, Nick. In this podcast, we'll review the performance of the managed care industry for the fourth quarter of 2018 and year-to-date 2019. We'll also discuss sector valuation indicators and operating trends. First, I want to speak to stock prices and valuation. As of March 5, stock prices for the publicly traded health plans are up by an average of 7.9% since the beginning of the year. This compares to the 11.4% increase in the broader market measured by the S&P 500. Health plan sector market capitalization decreased by 1.4% year-to-date since the decreases were skewed towards the larger plans. Stock prices for the 5 of the 8 plans gained ground so far, led by SSS at 50%, followed by Molina at 14%, Anthem's at 11%. WellCare grew by 4%, Centene increased by 2%, Cigna fell by 10%, followed by United at 5% and Humana by 3%. The valuation metrics were mixed since the beginning of the year, with the price to trailing 12 months earnings down by 11% to 19 times, and price to operating earnings increased by 13% to 17 times. Price to sales fell by 11% to 0.65 times. Price per total member increased by 3% to $2,700, and price per risk member fell by 19% to $4,400. All rates of change are calculated, holding the universe of health plans constant in both periods. Since our podcast last November, the average health plan stock prices are lower by 8.2%, with health plan market capitalization lower by 13%. The S&P 500 fell by 0.5% since November. Health plan valuation metrics also trended lower. On to our review of operating trends. For the fourth quarter of 2018, combined ASO and risk membership increased by an average of 8%, while increasing by 4% in total to 133 million. By average growth, I mean the average of each health plan's growth rate. Total reflects the change in combined membership for the plans as a whole. Fully insured risk membership increased by an average and in total of 6% to 74 million. Medicaid plans experienced an average growth of 15% and a total growth of 14% to 19 million members. Commercial plans reported an average gain of 1%, increasing to a total of 55 million risk members. Molina reported the largest decline at 14%, primarily due to a decline in marketplace membership from around 800,000 in 2017 to around 400,000 in 2018. The proportion of plans served under self-funded or ASO arrangements fell by 1.3 percentage points to 44.8%. On average, plans posted a 10.4% increase. Membership was up in total by about 1% to 59 million. Revenues for all plans increased an average of 13% and in total by 12% to 132 million. Medicaid plans reported $27 billion in revenues with an average increase of 21% and a total increase of 23%. WellCare reported the largest gains in revenue for Medicaid plans by 40%. Commercial plans increased by an average of 8% and in total by 10% to $104 billion. Cigna posted the largest increase in revenues. Premium rates for all plans grew by an average of 7%. Medicaid plans and commercial plans experienced an average premium growth of 6% and 7% respectively. Note that premium rate growth does not adjust for changes in product mix, geographic factors, or benefit design changes within the products offered by these plans. Operating earnings for the fourth quarter of $6.2 billion reflects a total increase of 17% and 93% on average. From this and other rates of change calculations, I'm omitting triple S. Its negative trends surged. Medicaid plans reported operating earnings of $800 million, an average increase of 186%, and a total increase of 110%. Molina's improvement was especially steep, with an increase of close to 500%. Commercial plans gained ground to $5.4 billion in operating earnings and an average increase of 72%, and a total increase of 10%. Average operating margins for all plans increased by 0.8 percentage points to 4.1%, again excluding triple S. Medicaid plans posted a 1.9 percentage point improvement to 3.3%. Commercial plans margin was flat at 4.6%. The health benefit ratio for all plans increased by 0.1 percentage points to 85.7%. Just a reminder, we at Sherlock Company, when we calculate health benefit ratios, exclude the impact of favorable and unfavorable prior reserve period adjustment. And in fact, what we do is when we hear their announcement, we remove them from the expenses recognized in the reporting period, which and then we allocate them to the quarters in which the underestimated expenses or overestimated expenses actually took place. The average health benefit ratio for Medicaid plans decreased by 1.9 percentage points to 82.9%. Molina's decrease was especially sharp, with a decline of 6.9% to 81.8%. Commercial plans posted a 1.3 percentage point increase in their health benefit ratio to 87.4%. The administrative expense ratio grew by 0.2 percentage points to 12.3%. Medicaid plans reported an average decline of 1.4 percentage points to 12.8%, while commercial plans experienced a 1.1 percentage point increase to 12%. Non-operating earnings fell by around $800 million. Our calculation of non-operating earnings is the sum of investment earnings, income earned in non-health plan business, less interest expenses. Medicaid plans reported non-operating losses of $12 million compared to larger loss in the prior year's quarter of $39 million. Commercial plans experienced a total decrease of $736 million to a loss of $211 million. All of these operating earnings comparisons exclude triple S. You might recall there was a hurricane there in Puerto Rico. So this non-operating earnings includes a property casualty business for the 2018 year had losses of $121 million. This compares with a $15 million loss in the prior year. Net earnings for the fourth quarter were higher for the plans, increasing by an average of 127%, and in total by 18% to $4.3 billion. Medicaid plans had net earnings of $500 million, a total increase of 169%, and an average increase of close to 400%. Commercial plans generated $3.8 billion in net earnings, a total increase of 9%, and an average increase of 5%. Revenues for all plans for the year ended 12/31/2018 increased by an average of 10%, and in total also by 10% to a total of $460 billion. Medicaid plans reported $99 billion in revenues, an average increase of 13%, and a total increase of 17%. Centene posted the largest gains in revenues for Medicaid plans by 24%. Commercial plans increased by an average of 7% and in total by 9% to $361 billion. Net income for 2018 improved by a total of 24% to $23 billion. Medicaid plans increased to $2 billion, a total of gain of 91%. Molina had net income of $750 million for 2008 compared to $77 million in 2017. Operating income increased by a total of 13% to $29 billion. Medicaid plans had a total increase of 79% to $3 billion, and commercial plans improved their operating income in total by 7.4% to $26 billion. I want to close by touching on a key environmental factor. In the income statements of health plans, administrative expenses are very small compared with medical benefits. But health plan managers give them disproportionate attention. First, each customer of a health plan is provided by the health plan with an array of administrative activities like claims processing, enrollment, and customer services. That is not the case for health benefits, which only a subset of customers offload onto health plans. For the share of membership that is enrolled in ASO arrangements, the health plan is not responsible for any health benefit cost variances. An unintended consequence of the Affordable Care Act is that benefit plan sponsors increasingly find self-insurance very attractive. Secondly, quote, managing the costs under your own roof, close quote, is something that can be performed by health plan officers directly. True, health plans have tools to affect health care cost trends. Rating and underwriting can contribute to a proper matching of health costs and premiums. Provider contracting can create the sort of appropriate incentives for providers to act as fiduciaries over their patients' financial health. And medical management can provide feedback to physicians as they guide patients through care alternatives. But the effect on overall health care cost trends is abstract from the management initiatives, since those providers are A, entirely independent from the health plan span of control, and B, providers' relationship with patients are difficult for the insurer to sever if required to induce provider compliance. The centrality of administrative expenses to health plan managers has been especially evident among publicly traded companies. When, in the early 1980s, United Health went public, it did so as a management company, not booking any revenues or premiums or health benefits in their very often nonprofit health plans that they were managing. Health America, now succeeded by the Aetna subsidiary of CVS, used similar accounting. Building on this, the old Partners Health Plan operations of Voluntary Hospitals of America operated similarly. So to provide a better understanding of the focus of publicly traded companies on administrative expenses, we have published an analysis comparing their ratios to those of Blue Cross Blue Shield plans. This analysis is unique in that it seeks to eliminate differences in ratios resulting solely from product mix differences. The PMPM ratios costs and the ratios of public companies are actually fairly similar to Blue Cross Blue Shield plans. We, by the way, populate the Blue Cross Blue Shield plan values from our Sherlock benchmarking studies. This bears on issues of economies of scale, but it is qualified by not knowing the distribution of the various public company administrative expenses in great detail. Now, this is free to MCOL members, but if you would please see the January 2019 Plan Management Navigator for further information. Again, it's free of charge, and you can get it by going to our website, which is www.sherlockco.com. In that vein, we are about to launch the 22nd annual Sherlock Benchmarks for health plans. I hope that you will reach out to us if you would like to consider participation. This is Doug Sherlock of Sherlock Company.
You have been listening to Doug Sherlock share his quarterly insights into the financial markets of health plans.